Good morning. We are student representative from Western Michigan University. So my name is Gan. So basically what I will do is I'll go through the reasoning and telling you about the price that we have for our recommendations. And Noel will be going through the competitive analysis and some acquisitions, merger acquisitions. And Eric will be going through the valuations method that we have used. So currently we have put our recommendations on hold for Stryker at $91.50. And today morning I checked on the market, it's about $96.50. So I think that our valuation is fairly priced. So let's go through the business segment. So business segment for Stryker mainly consists of three. The major one, which is orthopedics, med-surg, and also neurotechnology. So orthopedics is about 43% of the Stryker revenue. And then what it basically do is more towards the bone structure and reconstructive. And then the second one, which is the medical surge. So med surge is more towards the Strykers, about 39% of the revenue. And then it's more towards the equipment for procedures, for example, the medical bed, the Stryker bed over there. And the next one, which is the neurospine, ENT. So what the neurospine do is more toward, is about 18% of the company revenue, and basically on the stem cell, of the bone and the stem cell. Yep, and what we have received is merger and acquisitions will help the company to make this three to be more efficient. And 68% of the revenue is from the US for our company. Next, I'll pass on to Noel.
All right. Thanks, Gun. Historically, the medical device industry is traded at about 12% above the S&P 500. But over the past 10 years, the industry has seen things like stiffer regulation, product litigation, the Affordable Care Act, and economic recessions. In the past year, our industry has trended towards the middle, so we're going into a growth period, which is signaled by major product launches by Stryker, including the total knee and products acquired through the acquisition of MacoCore. Analysts do expect the industry to grow by about 11% in 2016, and with Stryker's basically US-based revenues, the Affordable Care Act legislation has had a great impact in the evolving business strategies. The industry has trended to do a lot of R&D as well as acquisitions, and because of this, the M&A activity for 2016 looks like a strong indicator of growth potential for Stryker. Industry analysts do project that Stryker's M&A strategy will boost 6%. From 2009 to 2015, Stryker has acquired just about 15 companies. 4 of these companies are listed here and represent some of the core fundamentals previously and going into the future of Stryker's M&A strategy. Stryker's M&A strategy has gone for high value-add companies and to add to their current portfolio and are poised for sustainable growth as they are integrated into Stryker's teams as these acquisitions take time. SBI and Mako were mostly about innovations in product and devices, whereas the more recent acquisitions of Sage Products and the asset acquisition announced this week of Synergistic USA are about adding a more diverse and current portfolio. This signals that Stryker is focusing their efforts on all product lines and they are able to take on more risk. With all products involving healthcare and human life, we expect a lot of ability for risk in the terms of product litigation. More recently, the metal-on-metal style joint implants have been called into question and recalled, with the voluntary recall a few years ago of the modular hip implant. Though most of these actual payouts are residing, it's not uncommon and it's not out of bounds to say that we expect massive recalls in the future, which impacts shareholder value. In terms of intellectual property litigation, there's not a whole lot going on there, but we do expect and we will accrue for intellectual property litigations in the future. Eric?
This is a supporting document that's really going to enforce what Noel just touched on about the litigation. Now, what you see here is you see return on equity over the past few years, and then also income margins over the past few years. And you can see once they started these recalls in 2012, their profitability measures are really taking a hit because of this. Now, you can see the substantial drop in the margins going into 2014, and then the associated recall amounts that was on their 10K in that corresponding time period. So litigation is always something that the company is going to have to be conscious of and know that it could impact their future. Now, under our valuation model, we used a free cash flow to the firm model, and it's unique in that it's a 3-stage model. So we have the first stage, which extends for the first 6 years. Now, for the first 6 years, we expect revenues to grow at 6 to 9%. So a fairly strong growth rate as a result of their acquisitions and their strategic acquisitions. The next period will be a 4-year period, and that's where we show growth tapering off, and then finally entering that final stage will be from the 10th year on, where we use a perpetuity a model or a discount rate to find the continuing value. Now, a few assumptions going into our model. We have a beta of 0.77. Now, this obviously reflects systematic risk. Now, Stryker is, they're not as sensitive to the market, and I think definitely with the new legislation, the Affordable Care Act, more people are going to have access to health care, and their company might not be as impacted by economic fluctuations because people need health care even when the economy is performing poorly. Now, our weighted average cost of capital is 0.8, and now, as we all know, with the acquisitions, they have taken out quite a bit of debt to finance this, and that is reflected in the weighted average cost of capital as well as the beta as a result. This is just a diagram here depicting some numbers that we generated from our model. Now it shows the revenue, and then the return on capital. That was another variable that our model really hinges on. Now we have a return on capital in between 16 and 18% going up until 2020, and then onward in the steady state we have a return on capital of 14%. So as competitors enter the market, and as their competitive advantages and core competencies get harder to defend and become under more pressure, we see that margins will decrease and return on capital will consequently fall somewhat. So that definitely has to come into consideration. Now onto the risk assessment. So again, litigation is always a risk, but Stryker, they are really underneath the legislation of the Food, Drug, and Cosmetics Act of 1976. Now this act has a few regulations underneath this act. Now the section 515 and then PMA is another substantial regulation that they have to contend with, and pretty much it makes sure that a company, before they can offer their product on the market, that it is designed correctly and that it's proven to work. They want to make sure that there's efficacy behind this product. And then the medical device tax. That's another that's been another issue that's really gotten a lot of talk recently. It's an excise tax, so it's a tax on revenue. Now it's 2.8%, and that definitely is going to impact their financial statements. And then again, with all the litigations, they have the potential that they might overpay for some of these companies, and then eventually you might have to impair some of this goodwill, or it might become impaired and they'll have to recognize it on their income statement, sort of like what we saw in the past few years. And then there's the risk that these companies that they're acquiring
There you go.
So in valuing the company, you used a free cash flow to the firm 3-stage model. Did you consider using any other models, discounted cash flow, multiples? To just kind of cross-check your results?
We considered the dividend discount model, but the company doesn't pay out all of their retained earnings in dividends. They don't always pay out all of their net income in the dividends. So we thought that might understate the valuation if we were to place a value or discount only the dividends. So we decided to use a free cash flow model and try to really just put a price on the operating assets of the firm, and really value just the cash flow, the main component there.
You talked about some of the acquisitions and the strategy that acquisitions were a significant use of capital for Stryker. So when Stryker makes an acquisition, and I certainly remember, the Mako acquisition, for about a year after or so, you didn't hear a lot about it. Now they're talking about it. Hey, we're selling more. Last conference call they touted it, but they don't break down their acquisitions after they fold them in. So how would you look over a long period of time and tell how effective their acquisition strategy has been?
So with any medical device, it takes forever and ever to get approval, with so many barriers to entry for the product alone. Then we have barriers to entry for an acquisition. We can look at what they say they're going to acquire, and then we can look at what their most recent acquisitions were, and we can see kind of what area of their business they're looking to expand, which will signify what their acquisition strategy is and what they'll go for in the future. Because in the economy, with the way it is, and Affordable Care Act and all that kind of stuff, it's raising all ships for access to health care. So in response to that, and in response to the market they have around them, they acquired Sage Products, which is disposables, and then they're acquiring the assets of the Synergistic USA company, which is another company that focuses more on your Band-Aids as opposed to your hip implants. So their M&A strategy is focusing on expanding their lines for the people who just newly have access to healthcare.
And with that M&A strategy, which of Stryker segments is most profitable from a margin perspective? And if you were the CEO of the company, which areas would you focus on?
With the current strategy we have, the MedSurg actually does have a highest growth rate. It's like 10.8% in 2014.
Okay.
And disposables do have the highest margin of any healthcare product available, so I would definitely say MedSurg.
You focused on the income margins, I believe, in your model. Were you also looking at the gross margins or the operating margins as well, and also the trend in margins?
Yeah, gross margin, mainly impacted by materials and raw materials that they use is some of the input products. From what we've seen historically, it's fluctuated somewhat, but normally it's been pretty steady. Some of the years may balance out the others, but as far as operating margin, it's also been pretty steady. Only exception being the recall expenses and some of the recalls that they've done.
Well, it's important to look at margin trends because margin trends impact earnings growth quite a bit. So that's one area that you're going to really need to focus on as far as when you're looking at valuation in a company and as far as selecting of multiples for the valuation as well.
I was, as we're going through, trying to keep track, just maybe to follow up on that, I think it's maybe slide 5 or so, but it's profitability measures. So if we could drill down on that for a moment, if you would. There we go. So, again, it's definitely on the right track of tracking those. So we've got we've got how do you deal with the anomaly then that you are showing for 2014 versus the rest of their margins and return on equities?
Okay. In 2014, what I can see from there is like mostly we are affected by the litigation. So the litigation is about half our net income. So mainly the litigation actually started from 2013 or 2012, I remember. So in 2014 itself, the litigation is about 500 millions. So the total earning without the litigations, you can see actually the Striker is growing. But then because of litigations, that affect us, so that you can see the drop in equity because of the litigations that affect us.
So how does an analyst adjust for that then in your forward model? Kind of goes on to John's question. So seeing that, you know what the adjustment is, you just described it. So then how do you pull that forward into your...
You recognize it for what it is. You know, it's an aberration. You know, it's just almost a blip. You know, you kind of just projecting forward. You business as usual in a way. You look at what it was previous to that, and then going forward. You know, you can't always predict. You know, the uncertain, but you can't necessarily account for. You can't account for how much it'll impact. You only know what you have leading up to that. So I just take it for what it is, and going forward, assume that they're not going to have any.
And
most analysts would view that as a one-time item, like a non-recurring. So for you to focus too much on that would, most analysts are just going to say, hey, it's a one-time thing. So it really doesn't factor in too much to any kind of analysis.
Yeah. So we are being conservative towards our evaluation because we think that there's a point maybe sometimes that might occur again. So we're being conservative towards our evaluations.
You had put a valuation of what?
$91.50. Yep.
Where's the $91.50 on that one slide, on the free cash flow valuation slide? And I don't know if you can kind of walk us through that a little bit. The valuation model explanation.
Yeah, we
come to grips with this.
So the RR here, that's called that's the reinvestment rate. So it's, imagine a retention ratio for cash flows. Basically, it's your capital expenditures less depreciation plus change in net working capital. And basically, that's how much cash that they're pumping back into the company and retaining. Now, as you can see, is as the company matures and as it continues to grow, it pumps a little bit more cash into its business, and in the steady state, that number would probably be a lot less, because they're going to be paying out more of their free cash flows. But it's also our model also hinges on the return on capital, because we used fundamentals for pretty much the bulk of our model. So return on capital multiplied by this reinvestment rate, we thought that would generate, give us an output of earnings before interest and taxes. So
when I'm looking at that bottom right matrix, you're going out 5 years, right? You got the EBIT, and then you got the after-tax EBIT there beneath it?
Yeah, that's,
okay.
yeah, 1 minus.
And you're coming up with a multiple on that, and then you're actually having that discounted back, or I'm trying to...
It's not exactly a multiple, it's more of a...
What you're missing, I think, is the free cash flow, the actual getting to the bottom line of what the free cash flow is that then you discount back, correct?
Right. This isn't exactly, our model. Obviously, you would take this amount here multiplied by 1 minus the reinvestment rate, okay, and then underneath you would have the free cash flows to the firm. So the reinvestment rate was just based, instead of projecting every line item, instead of projecting exactly how much depreciation or capital expenditures they had, we basically did was more of the, the reinvestment rate. So we just sort of assumed that a percentage and then projected that forward based on return on capital. So it's unique. It is probably a unique model. But we thought that the simpler we could keep it, probably the better.
Nice job.
Thank you. Thank you.